Welcome to the Explainer. So let's talk about the market. It's hitting all-time highs, which feels great, right? But at the same time, you hear all this chatter about a potential recession. It's a massive paradox, and honestly, it's confusing for pretty much everyone. So today we're going to crack open the institutional playbook and show you a strategy that's built for this exact moment. One that's all about balancing that risk and reward when the economy is at a huge turning point.
All right, so here's our game plan. First, we'll dig into why the market is so confusing right now. Then we'll introduce you to a really elegant solution called growth at a reasonable price. After that, we'll show you the 3 key signals the pros are watching, how to actually build a portfolio that can act on them, and finally, the secret sauce, the discipline you need to make it all work. So, let's just jump right into the big problem. You look at the market, and on the surface, everything looks amazing. But if you look just a little bit closer, you see it's packed with hidden risks that could trip up anyone. I mean, you can't argue with the tape. The S&P 500 is just pushing into record territory. And this isn't built on nothing. We're seeing some really solid earnings and a ton of optimism, especially around things like AI. The scoreboard is definitely flashing green. But, and this is a big but, there's a major problem hiding in the numbers. Inflation. It is just so sticky. Core CPI, the number the Federal Reserve really cares about, is still hanging out at 3.1%. That is well above their 2% target, and it just makes their job on interest rates incredibly difficult. And this is where things get kind of weird. Even with the market soaring, the big institutional players are still pricing in a 40% chance of a recession. Now, that is not a small number. That tells you that the people with the most skin in the game are seeing some serious cracks right below the surface of this rally.
So what are they seeing? Well, for starters, this rally is standing on really thin ice. It's not the whole market lifting up together. It's being pulled up by just a handful of mega-cap tech stocks. You know them, the Magnificent Seven. They now make up almost a third of the entire S&P 500. That's not a healthy broad market. That's a very, very concentrated bet.
And this brings us to the most important point here. Your diversified S&P 500 index fund, yeah, it's not nearly as diversified as you think it is. When the top 10 companies are making nearly 70% of all the profit, you're not really buying the whole market. You're making a huge bet on a few tech stocks. This basically breaks the #1 rule of index investing, which was supposed to be safety through diversification. So what do? I mean, how are you supposed to invest when the market is hitting highs, but a recession could be just around the corner? When the index is up, but it's all because of a few big names. The old playbooks either go all in on growth or hide in value stocks. They just don't cut it in a market this tricky. We need something smarter. And that brings us to the solution the professionals are turning to. It's a strategy called GARP, which stands for growth at a reasonable price. And it's not just some fancy acronym. It's a balanced, disciplined way to navigate a market that looks exactly like this. It all starts with a simple concept called a blend fund. So instead of choosing between those high-flying, super-fast growth stocks and the slow and steady value stocks, you just mix them. You put them together in one portfolio. The goal is pretty simple. Get the best of both worlds.
But GARP is a whole lot more than just a simple blend. It's a system for picking the right stocks. See, institutions don't just blindly mix growth and value together. GARP is a philosophy, a framework for how you select those companies.
And here it is, the secret sauce of GARP. This quote just nails it. You're hunting for those really exciting high-growth companies, but, and this is the key, you bring the discipline of a value investor to the table. You flat out refuse to overpay. It's about finding that amazing growth story before it gets too expensive. Now, this chart is really cool because it basically maps out the whole investing universe. Over on one side, you've got pure growth, high risk, high reward, loves a booming economy. On the other side, you've got safer, steady value, which tends to do well in a downturn. And GARP, it sits right in that sweet spot in the middle. It's the all-weather approach that's designed for a market that's in transition, which is exactly where we are right now.
Okay, so GARP is the strategy. That's the what. But the million-dollar question is when, right? When do you actually put it to work? For that, we need to learn how to read the market's tea leaves and spot the 3 key signals of a real, lasting recovery. It really boils down to these 3 things. And these aren't just some random data points. These are powerful indicators that analysts watch like a hawk. And when you see all 3 of them line up, that's your confirmation that a real recovery is taking hold, not just another fragile rally.
So first up is the yield curve. It's maybe one of the most reliable forecasting tools in all of finance. All it does is compare short-term interest rates to long-term interest rates. And for decades, when that curve gets steeper, meaning long-term rates are way higher than short-term rates, it's been a screaming signal that economic growth is coming. But there's a little twist this time around. We're probably going to see what some are calling a twisting steepening. So instead of long-term rates rising, it'll actually be the Fed cutting short-term rates that makes the curve steeper. The shape is the same, but the cause is totally different. And this specific kind of steepening has historically been fantastic for certain parts of the market. Okay, signal number 2 is all about market breadth. I want you to think of the stock market like an army. A real victory isn't when a few celebrity generals charge ahead while all the other soldiers are retreating. For a real win, the whole army has to be moving forward together. And this quote just says it all. If the S&P 500 is going up, but most of the individual stocks inside it are going down, that rally is hollow. It's fragile. For a recovery to be real and sustainable, you need broad participation. You need to see more stocks going up than down. And finally, the third signal, which is arguably the most important of all, corporate profits. Because at the end of the day, earnings are what drive stock prices. And the good news here is that analysts are forecasting a really powerful rebound, looking at a 12% jump in earnings growth by 2026. That, right there, is the fundamental fuel a real bull market needs. Okay, we have our strategy, we know what signals to watch for. Now for the really fun part. How do you actually build this thing? How do you put it all together into a portfolio that can take advantage of what's coming? The key concept here is something called tactical allocation. And listen, this is not a set it and forget it kind of deal. This is an active strategy. You're deliberately adjusting your mix of growth stocks, value stocks, and cash based on those signals we just talked about. It's about being nimble. And this matrix, this is basically the institutional playbook laid bare. It shows you exactly how to shift your portfolio over time, starting out defensive and cautious, and then shifting gears to capture growth as the recovery gets stronger. Let's walk through it. So, right now, in the next 0 to 6 months, the name of the game is defense. You can see the portfolio is heavy on value stocks and it's holding a good chunk of cash. The number one priority is just preserving your capital while you wait for those recovery signals to flash green. Then we move to the midterm. As those signals start to turn positive, you make the pivot. The goal now shifts to what the pros call beta capture, which is really just a fancy way of saying you want to catch the market's upside. You seriously ramp up your growth stocks, the 45%, and start to pull back on your defensive stuff. This is the key move. And finally, once that recovery has matured into a full-on expansion, you go on offense. Growth now becomes the biggest piece of your portfolio at 55%, and your cash position gets dialed all the way back. At this point, you're fully positioned for long-term growth. So what does that pivot actually look like? Well, it means rotating into the specific sectors that almost always lead the market out of a downturn. We're talking about industrials, consumer discretionary, and financials. These are the companies that benefit most from a rebounding economy, confident shoppers, and that steepening yield curve we mentioned earlier. But through all of this, you can't forget to hedge your bets. In today's world, just owning stocks and bonds isn't enough protection. The playbook calls for having things like gold to protect against inflation, owning the right kind of bonds for this specific yield curve, and always keeping some dry powder, some cash on the side so you can jump on opportunities. Okay, we have the strategy, we know the signals, we've built the portfolio. Now comes the hard part, actually doing it. Because it's one thing to have a great plan, but it's another thing entirely to have the discipline to stick with it and avoid the mental traps that sink most investors. One of the best tools for this is a really simple technique called dollar cost averaging, or DCA. It's a fantastic way to basically take your own emotions out of the investing process by putting your decisions on autopilot. In this slide just shows you how DCA brilliantly turns a scary market dip into a huge opportunity. Because you're investing the same fixed amount of money every time, you automatically end up buying more shares when prices are low and fewer when they're high. Over time, this drives your average cost way down and sets you up for bigger gains later. Next, you have got to know your personal line in the sand. Before the market gets crazy, you need to sit down and figure out your maximum allowable drawdown, the absolute biggest loss you can stomach before you start to panic. Knowing this number ahead of time is what stops you from making emotional mistakes later on.
Just remember, how you behave is just as important as the strategy you use. So here are the big don'ts. Don't stop dollar cost averaging when things look scary. That's when it works best. Don't get distracted by hype and start chasing risky assets. And never, ever invest without a clear plan for when you'll get out. You have to stick to the discipline.
So the outlook is pretty good. The fundamental ingredients for a strong recovery are there, especially those strong earnings forecasts. But as we've talked about, getting from here to there is not going to be a straight line. It's going to take a smart, balanced, and really disciplined approach to navigate the risks. So there you have it. You've seen the entire institutional playbook. You know the strategy, you know the signals to look for, and you know the discipline that it takes to actually pull it off. So the only question left is, how are you going to get your portfolio ready for what's next?